Well, hello, everybody. This is Bob Woosley, National Private Equity Practice Leader at Fraser and Dieter. And we've got a great subject today. There have been some changes in the research and development tax credit. And I'm here with one of our professionals, Tommy Zavieh. Hey, Tommy.
Hi.
How's it going?
Great.
Great. Well, Tommy, before we get into this, we're going to talk a little bit about how this affects a lot of our private equity clients, how it impacts their portfolio. But can you give the listeners a little bit about your background?
Sure. My background is a little bit different than my colleagues out there. I started out as an engineer and then wanted to go to grad school. Found out that I want to do something a little bit different. So I got my MBA and my MS in tax, where I think in this area of R&D tax credit, it's a perfect marriage between my engineering background and my tax expertise. And then career-wise, I've been to New York, California, Australia. I'm an expert in the Asia-Pac regimes, European regimes, and obviously the U.S. regime.
All right, excellent. So give us a high level. Most people have been practicing in business understand that there's a credit out there called the Research and Development Tax Credit. Today we're going to talk a little bit about some of the changes that have happened because the tax law is changing, the corporate rates are going down. Can you just take a step back and why does this credit exist? What's the government trying to do?
Yeah, so that's an interesting question. It started out actually after World War II. To give you a little bit of history here, we wanted to get back into competing with the world. So it started as a deduction that was put into the books to help companies spend money on research and development here in the U.S. And then it became a credit in 1981 underneath Reagan. And since then, companies use this to basically put cash back into the company and spend more money on research and development. So it's been around for quite some time.
Yeah, it's about the United States wanting us to innovate, continue to explore new products and services and that type of thing, right?
Exactly, and to do it here back in the U.S. soil and keep it here.
Okay, great. You've spent your career in this. I know you've recovered just tons of money for companies, but tell us a little bit about how the credit works. Can you give us some basics of, what companies spend their money on that qualify for the credit, and then we can maybe get into some common misconceptions about the credit. So give us an overview.
Sure. So from a very high level, many industries qualify for the R&D credit. It's not just your technology companies or large corporations or manufacturers that get a credit. It is a federal and a state credit. So both from a federal perspective, you can get a credit, and also from a state.
Great. So I didn't realize there were state credits. I always thought it was a federal credit, but you and I are sitting in the state of Georgia right now. So does Georgia have a state credit that kind of marries with the federal credit?
There's actually, over 40 jurisdictions, 40 states that provide the R&D credit. Georgia happens to be one of the better ones. Not only is it a pretty good credit back from your Georgia tax liability, but companies can also choose to offset their payroll tax. So say a company doesn't have a tax liability in Georgia. They're going to think about, well, why should I do an R&D study and get an R&D credit when I have no tax liability in the state of Georgia?
Right.
Well, they can offset their payroll with that.
Nice.
That's a pretty good chunk of change back in their pockets.
Do people normally miss that? I mean, maybe we ought to talk about that, because, you and I have been talking about a service we offer to private equity firms looking across their portfolio, with companies maybe in all different industries. And you just mentioned that the credit applies to different industries. I always thought it was like manufacturing. That's where the main focus might be. But if you were to look at what's commonly missed across a portfolio of, say, 15, 20 companies, how would you bucket that up?
I think the number one thing is education. Either the portfolio owners are unaware of what is R&D, or they may have misconceptions as to what is R&D. R&D, me being an engineer, I have a definition of an R&D, but that's my bias of being an engineer. The way that the tax code rules work is that that's not how you should look at it. There's just a 4-part test. As long as you meet it, your activities qualify for it. So number one thing I would say is education. From a portfolio perspective and from a entity perspective. Even the CFO or controller of a company may or may not know that they qualify for the R&D credit. So it's really important to talk to a specialist in this area to really gain understanding of what activities they're performing that could qualify for R&D credit. So that would be number one.
Mm-hmm. To interrupt, I mean, because that's what the exciting thing about what you bring to the table is you're validating what I've already kind of been feeling with my private equity clients, that they don't understand how much credit they could be getting that they're not getting. So you have this way of looking across a portfolio and kind of diagnosing likely candidates, right? I mean, can you talk about that a little bit?
Yeah, just think about you go to your general doctor practitioner, and he's going to be able to tell you a lot of things about you, but he's not going to be able to very quickly be able to tell you what's wrong with your heart. So they're going to send you to a cardiologist. But when you go see the cardiologist, you spend 5 minutes with that cardiologist, and they can diagnose you very quickly. Why? Because that's their area of specialty. They know their subject matter.
Right.
I know my subject matter. My colleagues out there know their subject matter. So talk to a specialist about this, because a lot of times companies are either completely miss that they qualify for R&D credit, or they're not maximizing their R&D credit.
Right.
So it's super important that you come and talk to one of us.
Right. You told me war stories where a company is tried to go for the credit and has taken the credit, and you've reviewed their credit calculations and found significant areas where they didn't capitalize on, like where they undershot it. Is that correct?
Not only did they undershot it, the company was publicly traded, and it had a significant impact on the earnings per share.
Mm-hmm.
So the company was not only happy that we found the credit for them, but it gave them a boost on their earnings per share when they announced that they were giving us credit.
Yeah, that's real value. And for a private company or portfolio companies of a private equity firm, that's all they're trying to do is create value. So you have a way of uncovering EBITDA that they're not seeing, and therefore value, and obviously cash and capital.
And for your private equity clients who are considering potentially buying a company,
mm-hmm.
that brings value to that company who's not taking their R&D credit.
Right.
They may have not known about it, or whatever they took may have been completely misstated, undervalued. So we can come in and help them value the R&D part of it and see, okay, well, there's cash to be had here.
I really like the service that you offer and it's a free offering to go into a private equity portfolio and do that high level diagnostic of likelihood. These companies probably would qualify if you took a look at it, and you can get there real quickly. I think that's tremendous value. So kind of moving up to a different topic, or related topic. What you do is highly specialized, and I know there's a lot of CPA firms that just don't have that kind of expertise. The average tax CPA firm can't really do this unless they're all in. Is that the way you characterize it?
Yeah, the way I would state it is, again, think of the analogy of a doctor.
Yeah.
Your general practitioner is going to be fantastic at being a general practitioner, but this is a very specialty area. It used to be an area that the IRS called it a tier 1. So they really came in and looked at it in detail as to what you were doing. So even if the general practitioner is putting a number on your return, that number could be at risk potentially if they're not doing it correctly and if they're not substantiating it correctly. So absolutely, this is an area that you want to talk to a specialist,
right, to
maximize your benefit.
Okay, and so let's move over to the fact that the tax law has changed. We have lower corporate tax rates. You were in my office the other day talking about how the research and development tax credits also had to change to mirror that. Can you talk a little bit about that? Because you were actually excited about some of the changes that would benefit a company with the credit.
Yeah, I equate this to winning a World Series or a Super Bowl championship. The R&D credit has not had many wins from a congressional perspective. It's been in the books, like I said, since 1981, but it has not been a permanent part of the tax code. When the PATH Act was passed by the president in 2015, it made it permanent. So when the current president passed the Tax Cuts and Jobs Act, by lowering the corporate tax rate from 35% to 21%, what essentially that did to the R&D credit is provided a boost of over 21% net benefit to companies who are taking an R&D credit.
Okay.
So you would say, okay, it's a 14% tax rate cut. How does that equate to 21%? Well, if you do the math, it actually is 21.54%. We're not going to go into details on this podcast.
Right.
But believe me, it is more than 21% benefit back, cash back in your pocket. So this is for us in the R&D tax credit world, this is like winning the Super Bowl or winning a World Series ring that we've been on the sidelines for over 35 years.
So that's really why it's super important right now to look at these credit situations, whether you're a private equity firm or just a regular company across your portfolio, because things have changed.
And things have changed for the best.
For the better.
For much better.
Yeah, that's great. Well, Tommy, I think, if we're to sum it all up, tax law has changed. Most companies, unless you have a specialist like you, miss opportunities. You have a way of helping diagnose it at a high level that's free of charge to our private equity firms. I don't know why they wouldn't want to take advantage of that. And four, not every CPA firm can do this. You have to be specialized to handle this. So I think it's great to talk to you about this. I'm excited to know that the credit's out there, and that we have this expertise, and I really appreciate your time. So Tommy, as we wrap up, we've talked about a lot today, and I really appreciate your expertise. I'm excited about what you bring to the table. Is there any other thoughts or any other things we didn't cover you'd like to point out before we close up?
Yeah, to our listeners out there, what I would tell you is just pick up the phone and give us a call.
Right.
My consulting fees are free for just having an assessment done. So give us a call. Let us learn about your business. Let us learn about your activities, and let's see if we can help you out. And don't go at it alone. This is not something that I would recommend you trying it by yourself or your general accountant. Hire a specialist in this area.
Yeah, and I will, I need to say that you can reach us at www.frazierdieter.com.
To reach me, you can email me at tommy.zavieh@frazierdieter.com. That's TOMMY.ZAV, like Victor, IEH, @frazierdieter.com. Or you can call me directly at 404-573-4514.
Great. Well, thanks again for your time. It's been great talking to you today.